If you really want to understand the timeline of a coming conflict, don't watch the aircraft carriers. Seriously, that stuff is mostly theater. If you want to know what a superpower is really planning, you have to follow the money. You watch the movement of sovereign debt. Because when a nation starts dumping its rival's debt at a speed that makes zero economic sense, well, they're clearing the decks for something. So, the US Treasury just dropped its latest data. And wow, there is one number that just leaps off the page. China's official holdings of US Treasury bonds have absolutely collapsed to $688 billion. Now, to put that in perspective, that's the lowest it's been since May of 2009. We've basically just erased 16 years of financial ties between the two biggest economies in the world. And here's the real kicker. They sold during a historic bond market crash. They knew they were taking a massive financial loss. This isn't just, rebalancing a portfolio. This is a signal. And the big question we have to answer is, why on earth would they do that? To really get this, we first have to wrap our heads around the sheer scale of this thing. This isn't a quiet, friendly separation. No, this is a loud, deliberate, and incredibly fast financial divorce. Just look at this timeline. It shows the total collapse of what people used to call chimerica, that kind of symbiotic economic thing between China and the US. Back in 2013, at its peak, China held $1.32 trillion in US debt. They were basically funding America's lifestyle. Today, it's down to $688 billion. They have dumped almost half their entire position. Folks, that's not a correction. That is an exit. So, in the world of asset management, there are really only two reasons you'd sell something that's already down in price. Reason one, you're in a liquidity crisis and you just desperately need the cash right now. But we know that's not China. They're running a massive trade surplus. So that leaves only one other logical conclusion. Beijing has decided that US Treasury bonds are no longer a safe asset. In fact, they see them as a massive strategic liability. And that right there brings us to the real motive. See, this whole thing isn't just about spreadsheets and economics. It's about geopolitics. There was one single event that completely changed how China looks at every single US dollar it holds. Remember February 2022, when Russia invaded Ukraine? The West pulled a financial move that sent an absolute shockwave through Beijing. With just a few keystrokes, they froze $300 billion of Russia's central bank reserves. Money that Russia thought was safe was just gone overnight. For the leadership in Beijing, this was a terrifying wake-up call. They realized that if a conflict ever broke out over Taiwan or anywhere else, their trillions in US debt wouldn't be an asset at all. They'd be a hostage. That $688 billion they still have could be seized and go to zero in the blink of an eye. This is what some people in finance call a burn notice. They're basically saying, we're willing to take a 10 or 20% loss today to avoid a 100% loss tomorrow. The priority has totally shifted. It's not about profit anymore. It's about escape. Get the capital out of US control no matter what it costs. But wait a minute, this creates a huge paradox, right? If the biggest foreign buyer of US debt is now the biggest seller, dumping hundreds of billions on the market, why hasn't the US bond market totally crashed? Why haven't interest rates shot to the moon? Well, the answer is in who's been quietly stepping in to buy it all up. I mean, look at this data from the Treasury. It's wild. As the line for China just plummets, two other lines are spiking to completely abnormal highs, the United Kingdom and Belgium. The UK's holdings have surged to over $750 billion. That makes their tiny economy a creditor on the same level as China. And Belgium? Their holdings are going vertical. What in the world is going on here? This is what we're calling the Bag Holder Alliance. And let's be clear, this is not a free market decision. Washington is effectively calling up its G7 partners and saying, listen, China is dumping. If you don't step in and buy this debt, the entire system breaks. It's basically a form of financial conscription, forcing allies to weaken their own balance sheets to save the whole system. Okay, so if China's selling its paper assets and America's allies are being forced to buy them, where is all that cash from the sales actually going? Because China isn't just sitting on a pile of dollars. Oh no, they are converting them into something very, very tangible. They're in the middle of maybe the most aggressive commodity buying spree in modern history. They're turning those paper claims into physical stuff across 4 key areas: gold, energy, industrial metals, and food. And the scale here is just staggering. For over 18 straight months, China's central bank has been relentlessly buying gold. Their strategic oil reserves, they're getting close to 1.5 billion barrels. That's enough to survive a blockade for months. Even with their real estate market in a depression, their copper imports are at all-time highs, and copper is a key part of making munitions. And maybe the craziest part, they now hold over half of the entire world's grain reserve. This shows a complete fundamental shift in their thinking. See, a nation at peace, it chases return on investment, with interest-bearing bonds. But a nation preparing for conflict, it converts its wealth into physical stockpiles. It's chasing what you might call a return on survival. They could not care less about a paper loss on a bond if that money buys the oil they'll need when the shipping lanes get shut down. Okay, so that's the giant geopolitical chess game. What does this massive financial divorce and China's great commodity hoard actually mean for you, for your money? How do you navigate what is now essentially a financial battlefield? Well, first, you have to accept a brand new truth. For 40 years, the 60-40 stock and bond portfolio was golden. Bonds were the safe part. That era is over. It's done. The U.S. Treasury bond is now the epicenter of a global economic war. It's an asset that depends on the kindness of strangers, who are very quickly becoming enemies. So here's a pretty straightforward 3-part protocol for how to position yourself, and it's based directly on the money flows we've just been looking at. Rule number 1, shorten your duration. Long-term bonds, like the 20 or 30-year treasuries, are extremely vulnerable if there's a buyer's strike. Think about it. If China keeps selling and the allies finally tap out, long-term interest rates have to go up, which crashes the price of all the existing bonds. You want to stay liquid and safe in short-term T-bills, think 1 to 6 months out. Rule 2 is simple. Follow the smart money. China is selling paper to buy stuff, real physical stuff. So you should probably consider owning the companies that produce that stuff. If China is hoarding copper, maybe look at copper miners. If they're hoarding oil, look at energy producers. These are the real assets that tend to do well when governments are forced to print money just to buy their own debt. And finally, rule number 3, watch the allies. You need a canary in the coal mine, right? An early warning signal for when this artificial stability is about to break. So you monitor the currencies of those key bag holder nations, especially the British pound and the Japanese yen. If Japan, which is the largest holder of U.S. debt, suddenly has a currency crisis and is forced to sell treasuries to save the yen, well, it's game over for low interest rates. So that $688 billion number, it isn't just a boring statistic. It's a countdown clock. China is systematically, methodically removing itself from the U.S. financial system to ensure its own survival. And all of this really leaves us with one final, pretty critical question you should be thinking about. The ultimate insider of the entire global manufacturing economy is getting out. Why are you still in?